Picture a supermarket with empty shelves. You call it a shortage. Now picture a truck full of apples outside. The owner says, "I won't sell apples and I won't buy yours either." That second scene is worse. The market's logic is broken. On Thursday, John 22, 2026, a Silver's pipeline flashed that warning, not from a commentator and not from a price chart, from a plain trade sheet issued by a major wholesale distributor. These wholesalers sit between mints, refiners, and the coin shops you actually visit. When they cough, the whole supply chain gets a fever. On the sell side, every popular item reads, "Sold out." Coins, bars, tubes, gone across the board. But the buy side is the shocker. Multiple lines are stamped "no bid," meaning they refuse to quote a buyback price. If this kind of forensic breakdown helps you, hit like and subscribe right now. It tells the algorithm you want real mechanics, not recycled noise. Now lean in, because this sounds impossible at first. How can a market be desperate to buy silver while a wholesaler won't buy silver? Here's the key. The issue isn't desire, it's funding. The system that finances trades is seizing up. In a normal week, wholesalers both buy and sell all day. They're the plumbing that keeps metal moving from source to storefront. They run on tiny spreads and fast turnover. That speed depends on cash and credit, not just inventory. So when a wholesaler prints "no bid," it doesn't mean silver is unwanted. It often means we can't deploy dollars safely right now. That's liquidity risk, not is it valuable. But can trades settle smoothly today? When liquidity fails, even strong demand can't clear a market. So you get a strange shortage. Supply exists, buyers exist, but trades don't clear. The middle layer can't fund the handoff. Let me map the chain in simple terms. Seller to local shop to wholesaler, wholesaler to dealers, and dealers to you. If the wholesaler stops bidding, the local shop loses its backstop. Cash turns into metal and cash stops circulating. So why would the middle layer choke? Because the wholesale model breaks when three assumptions fail at once. Number one, the no bid signal. No bid is capacity, not desire. It means the pipeline can't absorb inventory safely. Risk rises faster than funding. Number two, the hedge cash drain. Dealers hedge with futures to satisfy lenders. They can look neutral on paper. In a fast rally, margin pulls cash out daily. Number three, the credit squeeze. Banks tighten when volatility spikes. Haircuts rise and credit shrinks. Higher prices then need more dollars, but fewer dollars exist. Now we open the most misunderstood piece, hedging. It's designed to reduce risk, yet in fast markets it can turn toxic. A wholesaler isn't a stacker betting on direction. It's a logistics business trying to move volume and keep spreads. If price drops before they sell, losses erase months of spread. Lenders know that, so they demand hedges. The common setup is delta neutral. Long physical in the warehouse, short paper futures on the exchange. On paper, that looks balanced. If price falls, the short helps. If price rises, the inventory helps. The problem is cash timing. Physical gains aren't spendable until you sell, but margin is due immediately. In a rally, they can look rich and still run out of cash. Margin doesn't wait for inventory to sell. In a fast move, every dollar up demands more cash, daily. You pay just to keep the hedge open. Where does that cash come from? Operating capital, payroll reserves, and the same dollars needed to buy new inventory. They can sit on valuable metal and still go defensive. The hedge soothes lenders, but it starves cash. Once cash gets tight, bidding on incoming metal gets dangerous. A pause can be safer than triggering a funding spiral. Now add the second punch, credit. Wholesale bullion is a revolving credit world. Borrow to buy, sell to repay, repeat. When silver is cheap, a fixed line buys many ounces. When silver is expensive, that same line buys far fewer ounces. So capacity shrinks even if demand explodes. The pipe narrows simply because the unit price rose. Then risk models kick in. A steep chart screams volatility, and lenders tighten terms. They raise collateral haircuts, meaning they lend less against the same stock. Borrowing power can drop while inventory value rises. That mismatch is brutal. You need more dollars to carry stock, but the system offers fewer dollars to carry it. That's why no bid can sit beside sold out. It's not hate for silver, it's limited funding capacity. Now watch how the freeze spreads downward. Local coin shops rely on wholesalers for restocking and quick liquidity. If a shop can't sell upstream, it protects cash by lowering buybacks or pausing them. The community feels it as wider spreads. In stressed markets, premiums can rise while buyback bids lag. That gap is a funding symptom, not a value flip. Now here's the danger most people ignore. Price discovery gets messy. When fewer firms quote two-way markets, the real price becomes local. You can have one number on a screen and another in a storefront. The difference is a trust in liquidity premium, not a new law of nature. So what happens when silver is valuable but exits get jammed? What do you do if buybacks slow when you need cash? Block 2. First, separate value from liquidity. An asset can be strong while the transaction rails are strained. If you counted on instant buybacks, reset that expectation. In a squeeze, speed costs more and spreads widen. Second, think like a dealer for a minute. A dealer's biggest fear isn't price alone, it's funding pressure. That's why sell quotes can look bold while buy quotes stay cautious. Cash pays bills and inventory doesn't. Third, this isn't just a metals story. When credit tightens across the economy, commodity liquidity tightens too. A wholesaler can have buyers lined up and still pause. If funding costs jump, the machine must slow. Now, what happens to dealers under stress? Smaller shops feel it first because they have fewer funding options. Some limit buybacks, shorten hours, or focus on repeat clients. Others pause until volatility cools. That process concentrates market share in bigger firms. Less competition can mean higher premiums and less flexibility, but concentration also changes behavior. Big firms may go more conservative after getting burned. That's the hidden reset. Less leverage and more emphasis on real stock. The rebuild can be sturdier, but the transition hurts. Now, let's talk about the two-price world without drama. In stress, the screen price is a reference, while real quotes vary. When delivery stretches, buyers pay extra for certainty. When dealer cash is tight, buyback bids lag, even in a strong market. So don't treat one quote as the truth. Compare sources and watch whether a dealer still posts two-way prices. Two-way markets are the heartbeat of liquidity. When they vanish, you're seeing stress, even if charts look calm. Now, a safety and compliance note. Private transactions should follow local laws and basic personal safety. High premiums attract bad actors. In volatile periods, buyers lean toward reputable counterparties and clear paperwork. Authenticity matters more under stress. Use reputable verification, especially for high-value trades. Also keep your liquidity plan realistic. If you might need cash fast, don't assume top pricing on a tight deadline. Liquidity is a service, and services cost more when everyone wants them at once. That's why panic decisions often get the worst spreads. So what should you watch next? Dealer buyback posts, wholesale restock notices, and any public margin changes. Watch lending conditions too. Tightening headlines, funding stress, or sudden risk limit shifts. Those often hit the plumbing before the chart. And watch substitutions. When one product disappears, demand jumps to whatever is available and premiums reshuffle quickly. Here's another factor. Industrial demand is not sentimental. Manufacturers secure supply when spot markets feel unreliable. If industry locks supply, retail sees delays and higher premiums, then everyone leans on recycling if the network can process it. If dealers slow, recycling slows with them. Less return flow keeps physical tight after pullbacks. Zoom out. This is a stress test for intermediaries. Calm markets reward middlemen. Fast markets punish financing. That's why the trade sheet matters. It's not flashy, but it reveals whether trades can still clear. When you see sold out plus no bid, treat it as a warning light. The machine is overheating, even if demand is strong. And that changes holder behavior. If liquidity feels uncertain, people grip tighter and velocity drops. This is also why headlines miss the point. The story isn't love or hate. It's settlement rails under stress. Now, if you're asking, does this mean the market collapses? Not necessarily. Markets adapt by changing terms and rerouting flow. Adaptation can look like stronger relationships with trusted dealers. It can look like more focus on delivery certainty. It can also look like a wider gap between paper liquidity and physical availability. That gap moves with financing, not vibes. So keep your eyes on reality, not just screens. Delivery, spreads, and dealer behavior usually signal stress first. And keep emotions out of the driver's seat. Fast markets punish impulsive moves at the worst moments. Here's the open loop. If volatility stays high, does credit loosen or clamp down harder? That answer steers what happens next. If credit loosens, wholesalers can bid again and the chain restarts. If it tightens, no bid behavior can spread. So we'll keep tracking the paperwork. Trade sheets, margin updates, restock notices, and dealer quotes. Quiet documents tell loud truths. Want the next update the moment new data drops? Subscribe and turn notifications on. Comment locked so I know you're tracking with us.